Early stage term sheets. In trying to raise funds for an early stage company, entrepreneurs confront choices not only about the amount of money to seek, but also the terms and conditions of the financing. These terms are usually set forth in a term sheet that contains a host of provisions designed in varying degrees to protect the value of investors' capital. These terms help to secure the investor's ownership position, provide the right to monitor and control important company decisions, and facilitate exit from the investment. This note focuses on a few key terms: dividends, liquidation preference, anti-dilution, redemption, and control rights, all of which are widely regarded by practitioners as having the greatest influence on the returns and control to the parties involved in early-stage investments. Although in any given transaction a particular issue could arise that would require terms beyond those covered here, most early-stage investments require a basic understanding of these terms. After making the decision to invest in an early-stage company, investors must decide what type of security they will use to finance the deal. Early-stage investors are, for the most part, equity investors, as straight debt is rarely used by firms that have negative cash flows and relatively few assets. The most basic form of equity is common stock, but investors in early-stage deals rarely use it. Instead, they fund early-stage companies with a security that is senior to common stock called convertible preferred stock. One of the virtues of common stock is its simplicity, and some might say inherent fairness, which derives from its proportional claim on the firm. For example, if investors hold 10% of a company's equity, they are entitled to receive 10% of the dividends or 10% of the value of the equity at exit. Although this proportionality works well in a number of corporate contexts, it does not provide early-stage investors any advantage over the entrepreneur or seed investors who typically hold common shares. Given the high risk and investors' desire to protect their rights from the common shareholders, investors use a security senior that allows them to achieve a certain amount of control and downside protection that cannot be achieved with common stock. At exit, convertible preferred stock converts into common equity at the option of the holder, and the term sheet defines the conditions under which the conversion takes place. For example, if the preferred holders hold $10 million in principal with a $10 conversion price per share, so long as the exit value exceeds $10 million, the preferred shareholders will choose to convert into 1 million common shares at exit. Those common shares can be redeemed for cash as part of a sale of the firm, or can be sold to the public if the firm exits through an initial public offering or IPO. The conversion typically allows investors to participate in the upside created by their efforts, but also protects their downside should the deal not develop as originally envisioned. This note focuses on convertible preferred stock, hereafter referred to as simply preferred stock, as the main security used by early-stage investors. Let's begin by first looking at a sample term sheet to see the information it contains and how that information is displayed. A sample term sheet is shown for Ultratech Incorporated. Take a few minutes to read through it and think about how you might react to the language if you were trying to raise money for a firm you were starting. You will see a lot of legalese, and if you looked at several term sheets, you would also see that many of these terms repeat frequently. Our goal in this lesson is to shed some light on these commonly used terms and understand the differences among the alternative ways they can be worded to be more favorable to the company or founders, or to the investors or venture capitalists. First, you should understand a term sheet is not a legally binding contract, but serves as a prelude to negotiations and agreement on terms. It saves the parties time and costs if agreement on terms can be reached ahead of finalizing the contract. After agreement is reached on terms, a stock purchase agreement and other legal contracts will have to be drawn up by the attorneys for the parties. All term sheets list the amount of the investment, $10 million, the original purchase price for the shares, $5 per share, and the form of the security that will be issued to the Series A or first-round investors, in this case, convertible preferred stock. From there, it enumerates specific terms, dividends, liquidation preference, anti-dilution, and so forth. As the term sheet begins the process of negotiation, each of these terms can be structured in a way to be more entrepreneur-friendly or investor-friendly. It is important to be familiar with the range of possibilities to ensure a good outcome from the negotiation. Let's start with the first term in the term sheet, dividends, and then work our way through the rest as we proceed through this lesson. Let's start with the basic definition of dividends. A dividend is a distribution of the company's profits to its shareholders, which is generally paid in cash or stock. If it is paid in stock or additional shares of the company's equity, it is called payment in kind. Since profits are normally elusive in an early-stage company, cash dividends rarely occur, and any dividend paid usually must be declared and approved by the board of directors. Dividends in an early-stage deal can take the form of none, non-cumulative, or cumulative dividends. The most favorable outcome for an entrepreneur or the company is not to have any requirement to pay dividends. In this case, a dividend will only be paid to the preferred shareholders if and when it is declared by the board to be paid to the common shareholders. The preferred shareholders will receive dividends on their shares on an if-converted basis into common. In most cases, it is reasonable to assume that given the cash-strapped nature of startup firms, dividends will rarely, if ever, be declared. More frequently, however, investors receive a non-cumulative dividend. This gives the investors a preference to be paid first before the common shareholders if a dividend is declared. Oftentimes, investors receive an annual 6 to 8% non-cumulative dividend on the preferred stock, if and when declared by the board ahead of any payment to common shareholders. By being non-cumulative, it means if the board does not declare a dividend within an annual period, the right to receive the dividend disappears. At the other extreme, the most investor-friendly form of dividends is a mandated percentage of dividends to be paid on a cumulative basis. This form of dividend does not have to be declared by the board and automatically accrues to investors for as long as they hold their position. Cumulative dividends are not paid in cash, but are paid in kind. This means that for every $10 million invested, dividends accrue on the funds invested. For example, if the term sheet contains a 10% cumulative dividend, for every $10 million invested in the company, at the end of year one, investors will be owed $11 million. At the end of 2 years, investors will be owed $12.1 million, and so forth until an exit occurs. If an exit occurs at the end of 5 years, at that point, the principal and the amount owed to preferred shareholders increases to $16.1 million. The principal reason for a cumulative dividend right is to raise over time the amount preferred shareholders receive at liquidation relative to common shareholders. Following our example, if an exit occurs in 5 years, the preferred stockholders are entitled to be paid a minimum of $16.1 million out of the exit proceeds, compared to $10 million had dividends been paid on a non-cumulative basis. In effect, this allows investors to receive cash or a greater share of the exit proceeds at a time when cash is more readily available to the company. If investors do not achieve a high-valued exit of the company, then adding cumulative dividends to the liquidation preference at least locks in a minimum 10% rate of return for the investors. The following table summarizes a range of possible outcomes of the term sheet for the dividend term, from entrepreneur-friendly to investor-friendly. Be sure that the ordering makes sense to you now that we have covered these points in the note. Now let's turn to the liquidation preference. Liquidation preference is an important term that defines who among investors is paid first and how much they receive in relation to common shareholders. Legally, the liquidation preference stipulates the amount of money that the preferred shareholders must be paid upon a liquidation, dissolution, or sale of the company before any distribution of proceeds can be paid to the common shareholders. It can be thought of as a waterfall that defines the order of priority of payments when the firm has an exit event, such as an IPO or sale of the company. The liquidation preference is usually equal to the original amount investors provided to the company in a round, unless, as mentioned earlier, investors had cumulative dividends. Liquidation preferences come in two forms: a conventional liquidation preference, known as a single dip preference, or a participating preferred, known as a double dip preference. Either of these forms of preference can be further adjusted to include a cap, or as what is called a capped preference. Under a conventional liquidation preference, the preferred shareholders must choose between receiving their liquidation preference or converting their preferred into common to receive their pro rata share of the exit proceeds. Suppose a Series A investment of $10 million represents 40% of the equity ownership. Since the investors in this term sheet do not receive cumulative dividends, Series A's liquidation preference is the original capital invested in the deal, or $10 million. If the company is later sold for $100 million, investors choose between receiving the greater of $10 million or $40 million, their pro rata share of the exit proceeds, or 40% of $100 million, which is as if the preferred converted their shares into common. In this case, the Series A investors choose to receive $40 million, leaving the remaining $60 million to be paid to the common shareholders, assumed in this case to be the founders of the firm. In many deals, a capped preference is included in the terms. The cap imposes a maximum amount that investors can receive of the exit proceeds. It is typically stated as a multiple of the amount invested. Suppose in our example, the conventional liquidation preference had been capped at 2x. This means that although the investor's pro rata share of proceeds was $40 million, they can only receive up to $20 million of that, or 2 times the amount invested of $10 million. Under a conventional preferred, they now must choose between the greater of $10 million or $20 million. Thus, caps limit the extent of an investor participation in investor proceeds and generally benefit the entrepreneur. By comparison, a participating preferred eliminates the choice investors face under a conventional preference. Under this term, the preferred shareholders not only receive their liquidation preference, the first dip, but also participate with common shareholders on an if-converted basis, the second dip. A double dip participation feature does not apply when an exit occurs via an IPO and only applies when the exit occurs via a sale or merger. Consider the same Series A investment above, except that investors hold a participating rather than a conventional liquidation preference. In this case, Series A investors receive $46 million compared to $40 million under a conventional preferred. The $46 million is made up of the first dip, their liquidation preference of $10 million, and a second dip of $36 million. The $36 million is their pro rata share of the remaining proceeds, or 40% of $90 million, the difference between the total exit proceeds of $100 million and the first dip payment of $10 million. We can see that the participating preferred increases the internal rate of the return to investors to 35.7% compared to 32% with a conventional preferred. The relatively small increase in internal rate of return is largely due to the fact that investors are exiting at a high-valued exit. Investors in this deal received 4 times their money, or what would be considered a highly successful deal. To see the real impact of the participating preferred, consider what happens if the exit is not as good, and instead of exiting at $100 million, investors exit at $20 million, or a low-value exit. In this case, the Series A 40% stake or pro rata share translates to $8 million, or 40% of $20 million. Under the conventional preferred, investors choose between the maximum of $10 million or $8 million. Investors will choose the larger and receive $10 million in cash at exit. Relative to the $10 million invested, this results in a 1x multiple or 0% IRR on the deal. In this case, we see that the liquidation preference has provided investors with downside protection when their pro rata share of the exit proceeds turns out to be below their liquidation preference. Because of this term, they still receive their money back and avoid a negative return. Alternatively, if investors had a participating preferred, they receive their liquidation preference of $10 million and an additional $4 million, their pro rata share of the remaining proceeds. In this case, their total proceeds are $14 million, and this increases the IRR on the deal to 7% and the multiple to 1.4x. Notice that $14 million actually represents 70% of the $20 million exit proceeds. Although investors only had a claim to 40% of the ownership, the participation feature increases their share of exit proceeds well above that. From this example, you can see why investors might wish to include a participating feature in the term sheet. It's certainly better from their point of view to report 7% to their limited partners than 0% as the return on this deal. So when are investors more likely to try and negotiate a participating feature? The answer is the more they believe a low-valued exit is possible for the investment. When are low-valued exits more likely to occur? Well, there might be other circumstances. These are some that will likely raise this concern with investors. First, when entrepreneurs insist on very high pre-money valuations. Second, the later in the rounds that investors participate, C, D, and E rounds, for example. And third, the more guarded economic or market conditions are at the time of investment. But make no mistake, if investors insist on a participating preferred, it's important for entrepreneurs to understand why investors seek this term and why they may hold a relatively pessimistic view of the exit potential. The downside of a participating feature is that if the preferred get $14 million of the exit proceeds, the common shareholders who hold the remaining 40% of the equity have only $6 million left to distribute. Since that 60% includes the entrepreneur and other management, at some point there may be too little value left to incent value creation in the company. Further, if early round investors negotiate participating preferences, it can be difficult to raise new capital in later rounds if those investors perceive that the earlier round investors will take the lion's share of exit proceeds, leaving little by way of proceeds to distribute to them. Finally, I have included an example where the term sheet includes cumulative dividends to show how this term can further augment investor returns. As mentioned earlier, cumulative dividends work hand in hand with the liquidation preference to raise the liquidation preference of the investors. If the term sheet had included a 10% cumulative dividend and an exit occurs 5 years later, still at $20 million, the investor's liquidation preference increases to $16.1 million. The compounded value of $10 million invested at 10% for 5 years. Under the conventional preferred, investors will choose between the maximum of $16.1 or $8 million. Under the participating preferred, the total payment to preferred increases to $17.7 million, and the investors receive an astonishing 88% of the exit proceeds, which leaves a paltry $2.3 million for the founders, who at the outset of the deal thought they held 60% of the equity. Good luck raising a Series B with only $2.3 million left to distribute to investors after the Series A round. An important point of this lesson is to understand that although the firm exits at $20 million, the amount that investors and the entrepreneurs receive from this investment is critically shaped by the liquidation preference. This is why the liquidation preference is such an important term to understand in a term sheet. The table summarizes the range of possibilities for the liquidation preference.